What's your conviction about your company versus Bitcoin itself?
To be honest, I think that, investors should get exposure to both. But oftentimes holding Bitcoin can be trickier. It's something that people aren't familiar with. So stocks are a great way to look to do that. But specifically, when it comes to mining stocks, the benefit that an investor sees is there's generally an additional beta. When Bitcoin goes up, Bitcoin mining stocks go up more. If you look, for example, from the beginning of this year to date, mining stocks are up substantially more than Bitcoin. Bitcoin, doubled. Most mining stocks are up, 150 to 300%.
So welcome to our Bitcoin equity series. So this is the first episode, and we're hosting Zach Bradford, which is the CEO of Cleanspark. The Cleanspark is the third weight in our ETF at the time as we speak. And we wanted to jump on the call to get our investors to know more about your company and get us through all the background and the details of your business. So can you please introduce yourself briefly, and then I'll go through a list of questions that we have prepared for you.
Absolutely. Thanks for having me. So I am the CEO and co-founder of Cleanspark. We started the company in 2014. At the time, I was the CFO and was the chief financial officer of the company through 2019, at which point I took over as CEO. So my background's in finance and also in energy, which is ultimately what led us into Bitcoin.
Okay, great. And as a Bitcoin mining company, how do you position yourself compared to other Bitcoin miners?
So right now, we are about the third largest producer of Bitcoin of all US traded public companies. So we have 9 exahashes of processing power. Now, that's backed by about 280 megawatts of power. We have 5 fully owned data centers that we own, operate ourselves. And then we do have a small partner facility in New York where we co-locate, about 16,000 miners. So we have a large fleet of a little over 90,000 Bitcoin miners that are producing roughly 21 Bitcoin, 22 Bitcoin every single day, at least as of the date we're talking today. And we're doing so, on a fully funded basis. We recently just announced that not only is all the growth we have fully funded, but our future growth that we projected through 16 exahash, which should take us to be amongst the very largest miner in the US that self-mine, is all, the money's in the bank. It's fully funded and ready to go. And so we're really excited about it. We carry a very strong balance sheet and very low debt.
Okay, that sounds awesome. Just for me, for my understanding, when you say you're fully funded, how come you're able to be fully funded and yet expand while being fully funded without taking any debt? And this is quite unique, actually, in the Bitcoin mining space, where we saw last year a lot of Bitcoin miners going bust, and a lot of business models involving mining with leverage that suffered a lot and went bankrupt. How did you survive this 2022 crypto winter, and how did you manage to build the business model without taking any debt?
Yeah. So, Bitcoin is a volatile asset, and that's the key thing to understand. What happened in, 21 and 22 that caused some pain in the space was, it was very common for miners to do 2 things. One was to hold all the Bitcoin instead of selling any of it. And 2 was to seek out a lot of leverage. Now, leverage in a traditional business can work well for an asset-heavy business. The problem is when the assets change in value almost on the same scale as the volatility of Bitcoin, which means you have an asset. When you purchase it, it may cost $100. And then in a bear market, it may be worth $20. I'm just using theoretical numbers, but that's about as big a swing as we saw, where miners were paying about $10,000, $12,000 a miner, or miners today that can be purchased between $2,000 and $3,000. And so when you take out debt, you end up with two problems. For, one, paying the debt, the assets you're producing now don't go as far, but also you have lenders who may have options because of, being under collateralized to seek out more collateral or accelerate return. And so those two things caused a lot of debt problems. And then again, going back to the fact that no one was selling their Bitcoin. So at the peak of the market, we actually announced that it was not popular at the time. But we basically made a prediction that Bitcoin was peaking at the time in the 55, 60, $1,000 range. And we started selling Bitcoin. And that allowed us to cash flow our operations directly without needing debt to support our operations. Now, some of our other peers, they ended up ultimately being forced to sell these large, holdings of Bitcoin at, 50% value or less, even when Bitcoin bottomed out this last December at 60. So by, avoiding the leverage that we felt was overly risky, and instead relying on our operational cash flow, that's really how we did it. And, this comes down to being strategic versus ideological. And in the Bitcoin space, ideology around Bitcoin and holding it for extremely long periods of time is something that can, gather headlines, but it isn't always the right strategy for business. The same way that the gold miner doesn't hold their gold just to hold it. They need to sell it into the market, pay their bills, and keep their operations going. That was the attitude that we took. Now, contrast that actually with today. We're actually, now that we have, all of our growth or nearly double between today and near the end of this year taken care of, we're actually taking the approach that now is the time to start building our Bitcoin treasuries. So we actually doubled the Bitcoin in our treasury last month because we believe that there's now a trajectory of the market, especially with ETFs and things like that pending in the US to bring a lot of capital into the Bitcoin space. Really, now is the time to hold the Bitcoin. So, when you really break that down and how did we survive that time period, it was by choosing strategy. We made bold calls. We grew quicker than anybody else during the bear market. We really think that's the time to grow. When assets are low cost, it's the time to buy them and put them into use. And, at the bull markets, assets are expensive and we'll probably grow slower during the bull markets and instead look to just continue to build the balance sheet to grow stronger because Bitcoin is cyclical. There's going to be a bear and a bull market likely inside of every 4-year halving cycle.
Okay, that's quite unique actually, because what most miners I had seen were building Bitcoin treasury in 2022 and had to sell them in end of 22 and beginning of 23, and you did exactly the opposite. But
We did.
look at it deep down, what makes how come you have this crystal ball of knowing better than the other miners what's gonna happen? Because I find it very tough. Although the price prediction of Bitcoin for the next 10 years is very easy, going to the moon, but timing it so precisely, I find it a very hard exercise to do. So what kind of tools or measures or what's the secret behind your market calls or your Bitcoin price call actions?
Where we focused has been, partially on how Bitcoin is going, but really the underlying assets has been important for us, whether that's the value of the data centers that it costs to acquire. We've been heavy in the M&A space, or actually the servers, the Bitcoin mining servers. which I think usually it's almost like a canary in the coal mine. It starts to signal where the market is going. And what we found is by looking to that in addition to Bitcoin and kind of triangulating, it comes down to human behavior. And so when human behavior starts to take the form where people are willing to overpay for the assets that are connected to Bitcoin, such as the miners, that indicated to us the peak. So, for example, we've always had a goal as part of our strategy that when we buy a mining server, that it gets plugged in to produce Bitcoin as quickly as possible. That means you have to build the data center and everything that you need to plug it in, and then try and get the miner to arrive at the same time. The market in late 22, in late 21, they started buying miners where they were paying almost 10 times the amount that the miners had been priced at, 18 months before. And they weren't going to receive those miners for 12 months. And we looked at that and we saw a lot of miners going really heavy debt to make these purchases. And we saw that as irrational human behavior. And that human behavior where somebody wanted something so badly that they would ignore basic cash flow parameters. It means if you take debt on that, most of those parties had to service 12 months of debt without a cash flow producing asset. So you saw cash flows and a misalignment not occur. So we just felt that the supply and demand curve had been moved in the wrong direction. And so we actually took the position that it was actually better to, purchase slightly different models of miners, maybe paid slightly different price to buy miners that could be accessible within 30 days to plug in. And so that was really our focus, was purchasing the human behavior side of this. And that's really what pointed to the direction of things. Right now we're looking to the same thing, but we're using maybe larger market dynamics. We're enthusiastic about the ETFs, about what's happening in the regulatory environment where Bitcoin is looking to, more clearly, and I think it will become even clearer in the coming, 6 to 18 months, that Bitcoin is falling squarely for U.S. regulatory purposes into a commodity. Whereas U.S. regulators are really pointing to other cryptocurrencies as securities, which is creating additional risk around those. And then when you look at the ETFs getting behind it, because that certainty is becoming clearer, it's not done yet. The ETFs have not been through, but at least it seems like it's now about, if it's not if the ETFs will be approved, it's when the ETF will be approved. We think it's in the next 4 to 6 months. And that is our main indicator we're watching now, because the amount of capital that will bring in, if, pension fund and hedge funds have the ability to even just put, 0.5% or 1% of the funds into a Bitcoin ETF, that Bitcoin ETF will, bring a very large amount of capital into Bitcoin and further push it up. And when you combine that with halving, which, it has built-in scarcity, and for your listeners who may not be aware of what that means, for Bitcoin, in every 4-year cycle, the reward that we get as miners is cut in half. So right now we get 6.25 Bitcoin per every block, or 900 a day. And going into next year, that number gets cut in half. And so that scarcity, just like when, there's a high demand for something, well, when supply decreases in the same way, values go up. And so that's really the magic of Bitcoin, is the fact that the scarcity is a built-in focus. So when you combine scarcity with likely a large inflow of capital, it really seems like there's nowhere for Bitcoin to build up. So that's why we're seeing this as a time to start to build the Bitcoin treasury now that we've further solidified our balance sheet. So we're very enthusiastic about the coming year, and thinks that there's a lot of upside ahead of us.
Okay, awesome. So you're mentioning a lot of catalysts coming in the next 12 months, I would say. So the Bitcoin spot ETF, the clarification or qualification in securities for a lot of cryptos, and we see it starting, and it will probably continue. The halving, which will bring scarcity because the rewards of miners will, the supply basically to miners will diminish, and these you feel it's a good time for now to build a good treasury based on Bitcoin to capture the upside potential coming from all these catalysts. But what about yourself as a miner, seeing your future rewards cut in half in the next 12 months also would bring a significant reduction of revenues. And therefore, how are you preparing for it? How do you expect your company to do post halving?
Yeah, so there's a couple ways to look at it. So one is, with all these catalysts, Bitcoin goes up, and therefore any reduction in Bitcoin is offset by the increase in value in Bitcoin. But that isn't a plan, that's hope. And so we are very hopeful about Bitcoin, but instead we're focusing on preparedness and planning. And so an important thing to understand is the major cost of any Bitcoin miner is energy, basically our utility bills. And we've strategically located ourselves in a position that has abundant energy. Most of our operations are in Georgia, and we have very low cost power in the region. But not only do we have low cost power, but our machines or the power they use are highly efficient. So the average efficiency of a machine for every terahash for processing, measurement for a Bitcoin miner, the average is 40 watts or 40 joules per terahash. And basically every terahash is a processing, power that goes into solving the algorithm, and that leads to ultimately Bitcoin rewards. So on average, that is 40 to 43 watts. Our current fleet efficiency is 29 watts. And by the end of this year, for the upgrades and expansion we're making, our average fleet efficiency will be 25 watts per terahash. The fleet efficiency or the global fleet efficiency is still expected to remain above 39 watts per terahash, all the way through half. Now at halving, if Bitcoin stays flat, there's only two mechanisms that will allow a miner to stay profitable. One is a highly efficient miners, and the other is the cost of their electricity. And if you have less efficient miners, you need to have very, very low profit power in order to stay plugged in. Or what you do is you turn it off. And another great thing about Bitcoin and how it was so well thought through is there's a mechanism called difficulty, and that ultimately is the amount of rewards you get or how hard it is to solve that. And because there's a reward given about every 10 minutes, and if it takes longer or shorter, it gets harder or easier to solve that. And the reason that is there's an expectation that the algorithm will always seek out efficiency. And so what should happen if Bitcoin stays flat is miners that are not efficient, they will essentially be losing money. Because think of it this way, if Bitcoin gets cut in half right now, and Bitcoin is at $30,000 a Bitcoin, it's now worth 15. If your cost to mine a Bitcoin is over $15,000 a Bitcoin, you will be losing money and you have to unplug. Now, what that means is all the Bitcoin produced that day, more of it will go to the efficient miners. So there will be actually a windfall or increased number of Bitcoin that will be available to us because instead of there being, basically the pie stays the same size, but the slices get bigger. And that's what we really expect. Our current cost to mine a Bitcoin, which we expect to actually improve if we get more efficient, is around $11,500. And so at that point, if Bitcoin stays flat and the reward gets cut in half, we will still be profitable and we will still be able to mine Bitcoin. And all the other miners that are less efficient, they can choose to run at a loss if they want to, but you can only run at a loss for so long before you have to turn your machines off. And then the piece of the pie will get bigger for us. So that's really what we expect. I do expect it could be as much as 20 to 35%, or even more of the miners that are mining right now that won't be able to stay mining after the halving. So that means that our piece of the pie will get 20 to 35% bigger, or the number of Bitcoin being mined will increase by 20 or 30%, assuming, Bitcoin stays flat. And if it goes up, that means it's good for everybody. And, the size of the piece of the pie will stay the same.
Okay, interesting. And I just want to go through, I looked at briefly your latest results and started looking a little bit about your valuation. Today you have around the 1 billion market cap with 600 million of shareholders' equity. So this premium valuation, how do you justify it? And how do you find it? I remember when we first bought your shares, you were trading at a discount, at an equity discount, and today you're trading at a slight premium. Where do you see this valuation going forward, independently of the Bitcoin price?
Yeah. So importantly to note, if you actually look from a peer comparison point of view, we are still undervalued. And we've actually I'm going to use some comparisons. And again, each of us are a little bit different, but if you look at us, the number two Bitcoin miner from a market cap point of view, and then you look to us, there's actually another $1.5 billion difference. So their market cap is 2.5 billion, but we've outproduced them for the last several months. And that's where we think value actually is driven. So we have over 600 million in assets, and those assets are all producing Bitcoin every single day. And so our revenue run rate is over $200 million annualized as of right now. And we will be doubling the size of the company roughly to get to 16 exahash from 9 exahash. So just under doubling inside the next 6 months. So I think that there's a lot of growth catalysts that we haven't yet been given credit for. And, we're not a real estate investment where you value on a net value, net tangible asset value, because we're producing substantially more revenue from our assets than, for example, a real estate company would. And so instead, what we're seeing is, miners are being valued right now anywhere from 6 to 8 times future projected revenue. And we're still sitting on the low end of that. So, I'm really looking forward to, and what my focus is going to be is, now that we've reached $1 billion valuation, my real focus is on increasing that to $2 billion and beyond. And I think that we can do that by proving our operational excellence. So another thing that's different about Cleanspark is we have amongst the highest uptime or realized hash rate of anybody, and what that of all of our peers, I should say. And what that means is, if you look at the machine servers a company owns and the theoretical output that the theorists produced by that number of machines and that hash rate, where do your uptimes average? Our uptimes are consistently 98, 99% and above. Some of our peers are as low as 50% uptime. And that has a lot to do with the regions that we operate in. It allows us to have very high uptimes because of good temperatures, but also because our energy prices are very controllable and they stay low, as opposed to some of our peers who are in Texas. And for a lot of the summer, a lot of the miners in Texas have been required to curtail or turn off their facilities 20 to 50% of the time on average. So, our uptime, therefore our production and what we produce on a per asset basis is much higher. So what that means too is we've been able to also acquire miners for less than some of our peers. So what is $600 million on our book is partly because we've done extremely well following the market bottom, purchasing machines. I'll give you a direct example of this. The best server available in the space right now is Bitmain's Antminer XP. And we have paid as low as $21 to $23 a terahash to acquire these machines. Some of our peers paid between $70 and $110 a terahash.
Gosh.
So what that means is that our ROI and our payback on these assets is much lower. And although it looks like there's only 600 million on our balance sheet, some of our peers for the same amount of miners would show $1 billion or more of assets on their balance sheet. What that means is they paid more for the assets. They're not more valuable because under US GAAP accounting rules, you report the assets you purchase, fixed assets of this type, at their cost basis. So actually having a balance sheet at $600 million shows a benefit compared to our peers. It shows that we purchased better, and that also, therefore, we're going to have lower depreciation, which will affect our net income on a long-term basis. Most of the miners that we purchase will have between an 11 and 16 month full return on investment on what we purchase. Most of our peers, they have return on investments between 2 and 3 years. So our assets will pay back and produce, net positive cash flow quicker and more efficiently than almost any of our peers. Really, I would say any of our peers due to our uptime and the low cost at which we manage the miners. So although on paper it's 600, there's a substantially more value in the assets than what we have right now. And that's why I think that it's just about communicating that, getting that out in the market, continuing to outperform our peers. And that's how we're going to bridge the gap in valuation between where we're at right now and, our next closest peer, which has a market cap of over $2 billion.
You mentioned the current market valuation of Bitcoin miners being a multiple of revenues. But without looking at the market, what would you take as a valuation metric or as a way to compare miners and their valuation, and even in absolute terms, basically, because it's such a unique business that it's very tricky to apply traditional financial projections and modeling on your business. So do you find it correct to value Bitcoin miners according to their revenues, or do you see any other metrics that are not relevant? How can a financial analyst starting to look at your sector, how should he look at or how should she look at your company's valuation and other Bitcoin miners' valuation?
Yeah, I think that valuing on revenue directly would be, it is a little short-sighted. Now, most financial analysts have to pick something to tie multiples to, and then it comes down to giving weight to the secondary items. I think that there's a couple things that I think are incredibly important. One is track record and uptime. Can a company maintain high uptime? Otherwise, their revenue producing capabilities must be discounted, right? And then second is the efficiency of the fleet, because a company that is producing revenue now, even if they're at moderate margins, if their fleet efficiency, in my opinion, is over 32 joules or 32 watts per terahash, I don't think that they will be a profitable miner post halving, which is less than a year away. So next April, I think anybody over that 32 mark is going to be having a lot of trouble and will likely be mining at a loss. And so I think that's the key thing that cannot be ignored by a financial analyst is fleet efficiency. Second is cost to produce Bitcoin. Now, part of that is energy, which is the most important. But if energy is looked at by itself, then you're avoiding or you're not identifying the opportunities of scale, which is all of your other costs. Now, we, just like any other company, there's a lot of costs that go into being a large public company. We have lawyers, we have accountants, we have staff. We have almost 150 employees. And so we look at our all-in cost of mining, and it needs to be in a place that allows the company to be profitable. So the all-in cost of mining, the energy cost of mining, and the efficiency all need to be looked at, especially as we approach the halving event. And then the second is I want to go back to track record. Track record isn't the length of time that you've been in this space, but I really think everyone should be looking at how is the company maintaining its uptime, which involves the ability to repair facilities, repair machines, have, high quality data centers. When we invest in our data centers that we build, we do it the right way to make sure that there's true longevity in the systems. And, it's an indicator of problems if a company can't maintain that uptime. It means that they don't have a good repair team, that their servers are getting old, maybe their servers are getting overused, those run the wrong way. There's all kinds of things that go into power, frequency response systems, things that keep power running in very clean into these miners so that they don't get voltage spikes, things like that can cause damage. And so really you have to look at the quality. So all of those factors get an overarching, concept of quality. And this is something I really truly believe at Cleanspark can stand up against any of our peers and show that we're doing better. And again, scale will matter. Going into halving, we will be, at 16 exahash. Right now, we're about 2% of the global network hash rate. We'll be, 3.5, close to 4% at the current trajectory that we're going into halving. And that's going to make it so all of our overhead, it goes further. We don't have to increase our overhead to add more hash rate. So really all the hash rate we're adding at this point incrementally is going to the bottom line. So the bigger you are, the easier it's going to be to, post profits, but also, survive the bear markets as they happen. So we're really excited about the future and think we're incredibly well positioned.
Okay, awesome. I'll run all these numbers. I'll ask my team to run them and see how Cleanspark comes out based on those evaluation metrics you just explained. One last thing I wanted to ask you, given that we are European based and you have a European investor base that is very focused on ESG and climate change, what would you tell them regarding Bitcoin mining in general and Cleanspark more specifically? Overall, the ESG perspective and the sustainability perspective.
Mm-hmm. Yeah. So, Cleanspark, we actually have a background. We actually got our start as a company in the renewable energy space. And it was a really obvious move for us to apply that expertise and move into the Bitcoin space. And, we released I believe we were one of the first Bitcoin miners to release a sustainability report that I could point everybody to. You can find it on our website. We released it in the first quarter this year. And, at the time, yeah, based on our prior 12 months, we were mining at over 90% carbon-free power, amongst the highest of all of our peers. We are located in Georgia specifically because we were targeting locations with a high amount of carbon-free power. So Georgia is one of the few places where nuclear power has continued to be turned on. And, as much as nuclear power can, have opinions on both sides, it doesn't produce carbon. And that's been our focus, is being in places where um, you know there's good generation assets that aren't producing carbon. We also do participate in several renewable energy programs in the state of Georgia. Specifically, in the prior year was a solar program, and in this year we're on a program called the Flex Rex, which do support the building of renewables in the state of Georgia. And also, it's important on when you look at the social part of this, where we're locating is actually largely in rural areas and towns inside the state. And what that's providing for us is the ability to give back to the communities that we operate in. These are communities that, oftentimes are disadvantaged because they lost, factory jobs from, years ago. But that's also why they have these energy resources. And so we can come into the towns, we can add jobs, we can support the community, and we're very active in our communities and interacting with them. And we think that that's just as important as our environmental impact goals is the social impact that we do have. So that's really where we've been focusing. We, of course, do believe that Bitcoin is, really a transformational financial technology. And that's also important on the social side. It allows a lot of people in less advantaged places in the world to have a good store of value, to have something that, is potentially, anti-inflationary. And also, to take normal, some of us take for granted the banking access that we have. A lot of people don't have banking access. So this, again, provides people the ability to transact, to save. So we really believe in what Bitcoin is doing also for the broader world outside what we're doing in just.
Okay, awesome. One last question before we finish this interview. How do you compare holding Bitcoin versus holding Cleanspark, or Bitcoin miners, but preferably Cleanspark? How should an investor look at one versus the other? If I have the possibility to buy Bitcoin or buy Cleanspark stocks, why would I do one or the other? Or why would I go for Cleanspark? Obviously, because this is, I suppose, where you're in business, and this is where your value proposition lies. So,
Yeah.
what's your conviction about your company versus Bitcoin itself?
To be honest, I think that, investors should get exposure to both. But oftentimes holding Bitcoin can be trickier. It's something that people aren't familiar with. So stocks are a great way to look to do that. But specifically, when it comes to mining stocks, the benefit that an investor sees is there's generally an additional beta. When Bitcoin goes up, Bitcoin mining stocks go up more. You look, for example, from the beginning of this year to date, mining stocks are up substantially more than Bitcoin. Bitcoin, doubled. Most mining stocks are up, 150 to 300%. And so, there's, I think, a better yield that could be generated from mining stocks. And this also comes down to the fundamental value proposition to miners. We're essentially able to have a direct cost of mining, like I mentioned before, which is our energy cost. of 11,500 when we get Bitcoin. So that means we're essentially in the business of investing 11,500 or Bitcoin, which is worth 3 times as much, roughly as of right now. And I think that's why mining stocks get the benefit of a substantially higher, beta or yield upside in when Bitcoin makes market moves and goes up, is because our cost of acquisition of Bitcoin is lower than it is for anyone else. And it's lower because we're incentivized to support the network and provide the backbone for what Bitcoin really is. So, I'm a believer in having a little bit of Bitcoin in my own portfolio. We, of course, as a company, have Bitcoin in our treasury. But also, I'm a real believer. I, of course, am one of the largest shareholders of the company. And I am in this business and believe in the company, what we're doing, because I do think that mining stocks do have that, beta difference where they will go up more than Bitcoin goes up on a percentage basis, as Bitcoin continues to climb.
Okay, beta is an interesting value proposition, but what about alpha? Do you see any additional value or risk-adjusted value coming from holding a Bitcoin miner or Cleanspark, more specifically, versus holding Bitcoin?
Yeah, if you also look at, Bitcoin on a dollar by dollar basis, on a risk adjusted, there's a lot of ability to move in and out of mining stocks, but ultimately, I think that if you look at and I'm going to use the year to date, although there's a lot more data than that, but the year to date has been really interesting in the sense that, when Bitcoin ticks up, miner stocks go up more. When Bitcoin ticks down, miner stocks are still going down a little bit, but they're not going down as much. And that's allowing us to, retain more value. I also think that there is a basis on the investment where it's really about, value production. And, as long as we can produce Bitcoin for 1/3 the cost of a Bitcoin, there's a 300% value for every, or 200% value, 3x up, for every Bitcoin we produce. And so as a shareholder, to be able to participate in that upside is, I think, the value proposition in this process. So, there's a lot of reasons, and I think that it comes down to what's the reason that, investors invest in Bitcoin mining stocks. Is it for direct exposure, or is it for indirect exposure to Bitcoin? Is it due to the ability to generate, cash flows at very high margins? And I think for me, it's about both of those combined. And I think that provides a lot of value upside when compared to holding Bitcoin directly.
I totally hear what you're saying, and actually, this is what I spend my time telling my investors, because everybody's excited about a Bitcoin spot ETF, while they should be excited about a Bitcoin equities ETF like we have listed, because we see Bitcoin as decentralized currency, and you don't see any USD spot ETF or Euro spot ETF, because there's no value in holding the currency itself, but rather holding the companies that are building on this new technology, on this new ecosystem. And these are the ones that will really benefit from the exponential growth, much more than Bitcoin, and the year-to-date performance have showed it indeed. I'm gonna conclude with these words to thank you very much for this interview, and I hope we'll be jumping more often on such a discussion together to talk about your results, but also the market in general, and how the ecosystem is evolving. Thank you very
Excellent.
much, Zach.
Hey, thank you. Look forward to it.